Hey there, this tutorial is going to be our first one to deal with Chapter 19, Dividend Policy, Dividend Theory. This tutorial in particular is going to deal with essentially the financial theory of dividends, chapter or section 19.1 in the book. And the question is going to be how dividends affect the balance sheet and the total cash available to owners of a firm. And we're going to look at a very simplified case when there are no taxes to be paid. When we think about this entire chapter, I want you to put your mind in the place of being a business owner. All right, you go out, you start a business, and you will be working very hard. You're going to be taking a lot of risks, right? And you're going to be willing to pay whatever you owe in tax, right, to the government. However, you don't want to pay any extra tax, right? You want to be able to draw money from your firm when you need it, right? You want to take a vacation, you want to buy a house, you're going to want to be able to draw money out of the company for those purposes. But you're going to want to do that in the way that results in you needing to pay the least amount of tax, right? You know what the rules are, you'll know what the tax code is, you know what you can do, and you'll want to do the thing that is the cheapest, right? That results in the most money you can get for the littlest amount of tax. So in our simple situation, assuming no tax burden, we're going to just do a quick analysis. The thing to remember about all of these examples is that I'm not going to give you an answer about which is the best, right? Which is the best way to get money out. I don't want you to go home, lock away in the back of your mind that the best way for an owner to take money out is through paying themselves a bonus, right? Because if we conclude that today, that's based on only the data that we have, right? It's based on the tax rates we're assuming. It's based on the money that the firm makes, right? Anytime the tax code changes or the rules change about how a firm can pay themselves, we're going to need to go back and redo the analysis, right? It might turn out the bonuses aren't the best, right? Policy, government policy, tax policy could change, and dividends could later be the best. So let's start with two examples. I want to create a balance sheet or two balance sheets for two hypothetical companies. Let's create two pizza companies, and Jeff is going to have one, and Lauren is going to have the other one. Jeff and Lauren are students in my spring 2015 class, and they are now budding entrepreneurs, and they own pizza companies. All right. We're going to create their balance sheet for their pizza companies. We're going to assume these pizza companies are identical, right? Jeff and Lauren, they went to school together. They went to baking school together. These firms have identical free cash flows and identical balance sheets. So we'll take a look first at their assets. And over here, we'll look at their liabilities and equity. So for assets, we've got cash and we've got equipment. One current asset, one long-term asset. We're being very simple. And on the liabilities and equity side, we're going to have debt, and then we'll have some equity, and our equity is going to take on two types. Stock, the money that you invest in the firm when you file the articles of incorporation, and then accumulated retained earnings, which is all of the net income that you have ever made but not paid out as dividends. So let's bold these two. So let's say that Jeff's firm has $10,000 in cash and $65,000 in equipment, and that's going to give him total assets of $75,000. And then let's say that Jeff's pizza company has $25,000 in debt. And then in terms of equity, he's got $15,000 in stock. He put in $15,000 to start the business. And then over time, he has retained $35,000 in net income that he hasn't paid himself, which means his total liability and equity is also $75,000, right? So we've got a balancing balance sheet. Well, for simplicity's sake, so we can make good comparisons, Lauren's balance sheet is exactly the same, right? We've got two identical firms. All right, so the question that owners of these two firms have, right, Jeff and Lauren, is how can we best maximize our wealth and pay ourselves when we need to? And for starters, let's just say that Jeff is happy leaving his money in the firm for now, right? He doesn't want to take a trip. He doesn't want to buy a house. He's just leaving his money in the firm and he's growing the firm. Lauren, however, her best friend just announced that she was getting married in Fiji. I'm making that up. Lauren's best friend really didn't announce that, but we're pretending that Lauren's best friend announced that. And Lauren is going to go to Fiji for a month to be the maid of honor, and she is going to have a wonderful vacation. Well, what she needs in order to do that is some money. And where is she going to get it? She's going to get it out of her firm. So let's take Lauren's Pizza Company, and I'm going to copy this down here. And I'm going to say Lauren's Pizza Company, and this is going to be her balance sheet after she pays herself a dividend. All right, Jeff's, we'll copy it and bring it down here. He has no dividend payment. So let's let this dividend payment be $5,000. All right, so $5,000 dividend, where is it going to come from? Right, it's going to come from cash. She has $10,000 in the bank, and she's going to take $5,000 of that out of her firm's bank account, and she is going to transfer that into her own bank account, right? Will our total assets amount remain unchanged? No, it's not. It's going to fall by $5,000, right? That $5,000 that she paid herself. On the other side, we've got to take $5,000 out of something so that these two numbers here, so that our balance sheet can balance. Where are we going to get that money? We're going to get that money out of retained earnings. So sometimes you hear people say that dividends are paid out of retained earnings, right? That's what they mean. It reduces the balance of accumulated retained earnings. Where dividends really come from, in my opinion, are cash. You have to have cash. You can have all the retained earnings that you want, but if you don't have cash, you can't pay a dividend, right? So think of dividends as coming first out of cash, but they balance with a reduction from retained earnings. So those are the two things that happen when we pay the dividend. First is that the cash balance is reduced. The second is the balance of retained earnings falls to offset the fall in cash. Okay, we got it. So now we've got two firms. These same two firms now have reduced assets and reduced liabilities and equity, right? Is that important, right? Does that matter? Well, it matters for two reasons. One is that we want to see if it's going to impact the amount of money that either owner can take out of the business. And it also will matter if it changes the value of the business, right? So there's a couple of things that I want to point out, or one that I mentioned earlier. One is that both of these firms have identical free cash flows. Right? Meaning that the amount of money they make from operations are equal. Second is that we are going to assume that there are no income taxes, no corporate taxes, capital gains, or dividend taxes. Okay. So let's take a look at and see how this decision to pay a dividend in Lauren's case and not pay a dividend in Jeff's case would impact these two people's ability to take money out of the business, right? And in order to do that, we're going to take a look and do a quick analysis as though they were selling the businesses, which we know they're not, or we're assuming they're not, but it's still going to give us some information on how money could come out of these firms, right? Let's say that both of the firms, they've got identical free cash flow, and that the present value of these free cash flows, right, if they did a valuation, let's just say it would be equal to $100,000 to make our information simple. So that means that we are going to be in a situation where they are going to sell the firm. It would be worth, the enterprise value would be worth the present value of the future cash flows. So now let's take Jeff's Pizza Company, bring our heading down here, and Lauren's Pizza Company, bring our heading down here. And in each case, let's sell these companies for, sell these companies for $100,000, which is the present value of their future free cash flows. All right, what's that going to do for us? Well, let's take a look. We're just going to create basically a cash flow table like we would when we were calculating terminal value in other videos or in other parts of the class. So we're going to have our sale price, and then we're going to need to do what Beninga does in the text if you're looking at the text. He calls it paying off net debt, which is a perfectly legitimate term. I like it quite a bit. However, it's not what we did when we were calculating value of equity in Chapter 7. I'm going to follow that approach because I think it will make a little bit more sense to you. So if we sell the company for $100,000, right, we are not going to sell our cash and our debt within that $100,000, right? We're going to add our cash and we are going to subtract our debt. Right, so that's just what we did when we were calculating the value of equity. So Jeff will get $10,000 extra for the cash he has, and he will not have to pay, he will receive $25,000 less for the debt that he has, because the person who buys the company is also going to get the cash, and they're going to have to pay off the debt. So the amount that they're actually going to have to give the owner right, in this case, how much would Jeff receive for the sale? Right, it would be equal to the present value of the future cash flows plus the cash in the bank minus the debt. Right, so Jeff would receive $85,000 in the sale. However, we have capital gains taxes to pay. So we need to look at his basis, right? His basis is the book value of the equity. The book value of his equity is the stock plus the accumulated retained earnings. And so he's got a taxable gain. Just looking familiar? $85,000 minus $50,000. So he will need to pay tax on this gain. But in this case, we're assuming that we've got a 0% tax rate, right? So he would pay 0% times 35,000, otherwise known as 0. So when he went to take the money to the bank, what would he have? He'd have the 85,000 in cash he received minus the 0 in tax that he paid. He'd receive this $85,000. Right? Just as a purpose of comparison, we're going to do this in a second when we look at Lauren's. We're going to add the cash taken in the form of dividend, right? Which in his case is 0. He didn't take a dividend. He won't have paid any taxes on that dividend. But now, the amount of cash that goes to him in total, right, $85,000. I'm going to borrow these, bring them over here for Lauren. And let's take a look at her selling the company. Well, the present value of her future cash flows are still $100,000. However, she's got slightly less cash because she took some money out in the form of dividend. So the cash to her as an owner is going to be slightly less than the cash going to Jeff. Can you see that difference there? Right, here's a difference between these two. There's less cash for the sale exchanging hands. Right? But what about the book value of equity? How much is that going to be? Well, interestingly enough, she also has less equity because she's reduced her retained earnings. So the taxable gain, otherwise known as subtraction, turns out to be the same, identical taxable gains. Interesting. Well, we'll have a $0 gain, our tax on that gain, and so our net cash from our sale is going to be $80,000 that she receives minus the tax she's got to pay. So here it looks like she's getting $80,000 out of the firm for selling it, right? So our purpose here is to say, well, is taking a dividend out going to change the amount you can get out of the firm, right? And what we're going to see immediately is, yes, if you were to turn around and sell it, the fact that it has a little less equity and a little less cash would impact how much you could sell it for, right? It's comparison. However, we took $5,000 out as a dividend. With no taxes, we'd pay $0. So in total, Lauren is going to be able to pull the same amount of money as is Jeff out of that firm, right? He would get his all from the sale, and she would get hers part from the sale and part from the dividend. So what's the point, right? Why are we doing this? Why do we care? We care because we're trying to show that in the absence of taxes, the value of your business and how much you can pull out of it isn't going to change if you choose to pay dividends to your owners, or if you decide that you want to keep the money in the firm, right? In the absence of taxes, it's basically irrelevant. And this is part of a theory that's called the dividend irrelevance theory, which we won't get into too much, but it's just an idea to think of. Okay, if you have no taxes, these dividends are going to be irrelevant for how much money you can pull out of the firm. All right, that was a relatively long video to illustrate that point. The next ones will be shorter because we won't recreate this. All right, happy calculating. Email if you have any questions.